Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and this is Trading Places Live. It's Thursday, June 16th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Futures this morning down a lot, giving back all the gains we saw from Wednesday. We had the Fed meeting, big gains, maybe surprising gains to many. Well, they're evaporating here at the open this morning. Today's going to be a really interesting day, and we're going to talk a lot about that throughout this session. But currently, I am showing futures down. Dow Jones futures down 530. S&P 500 futures down about 83. NASDAQ futures just a little over 300 points. We are still, at this point, a couple hours away from the opening bell. Things can change. I know when I went to sleep last night, futures were green. So I was a little surprised when I woke up and saw the bright red futures this morning after the rally we had after the Fed meeting, an announcement at 2 p.m. Eastern on Wednesday. But hey, when you've got volatility up here, this is what you get. You never know what you're going to wake up to. I believe the stock market is in the process of bottoming. I talked to our members at EarningsBeats about that here over the last couple of days with one caveat, and that was we got to get through the Fed meeting. Didn't know what might happen after the Fed met. Figured we could go up, we could go down. And then if we go down, I thought maybe we'd get a big gap down on Thursday, which could mark a bottom this morning. Of course, we didn't go down yesterday afternoon, which makes this kind of a move down a little bit more surprising to me. But there are things to watch in this move on Thursday and how the market trades on Thursday. I think this is going to be one of the most important trading days, maybe the next 2 days, today and tomorrow. I think could be the most important in trying to determine whether or not this truly is a market bottom. But I'm going to get into all of that in just a couple minutes. First, let's go through the agenda for today. So I'm going to start off with that daily market recap, jump into talking technically. Let's talk about rotation. I think rotation and sentiment. I think those are going to be the two keys today to watch for. Sentiment has finally reached, when I said back at the end of last year, beginning of January, that we needed to reset sentiment. I believe today is going to be the day when it is officially reset. What I was looking for back then, I think we've now hit it. Doesn't mean it has to stop here, but we need, in order to have any chance to continue to move the market higher, we needed a period of weakness. We needed a period of bearishness so that all the folks that felt like the market couldn't do anything but go up, we needed them to flip. We needed them to say, this market can't do anything but go down. And I think after 5.5 months, I think we're finally there. Again, doesn't mean for sure that we're at the bottom. It simply tells me that now we're in a position where the stock market could begin another launch to the upside. So we need corroborating signals. And that's, again, what I want to be talking about. Then we'll take a quick look, earnings spotlight, not really a whole lot going on there. And then we'll wrap up with the 3 you must see. Before we get into any of that, though, let me take you over to EarningsBeats.com. For those of you that are new, go to EarningsBeats.com, scroll down. We have a free newsletter. If you want to learn more about us and the way we approach the market, this is the best way to do it. All it takes is your name, email address, hit that subscribe button. This is a 3 times a week newsletter, Mondays, Wednesdays, and Fridays. It'll be delivered to your inbox right around 8:30 in the morning. Sometimes I'm a little bit later, so we can't quite get it out that early, but that's our target. We normally try to shoot for about 8:30 in the morning. It features a number of different things that we like to look at. Relative strength, earnings, gaps, candlesticks, rotation, the things that I'm going to be talking about a little bit today. Anything that I find interesting, I pass along to our EarningsBeats Digest community, and it is completely free, no credit card required. You can unsubscribe at any time. If you don't feel like you're getting something out of this newsletter and want to unsubscribe, that's fine. I promise you're not going to hurt my feelings. This is, we started this newsletter really just to give back. I've spent my whole life educating, and I enjoy teaching things that I've learned. And that's what the EB Digest is all about. And if you like what you read there, then you're going to love our service at EarningsBeats, because we're all about research, education, guidance, those types of things. So really what this is designed to do is bring that EarningsBeats community together, teach some things, and then if you want to take it to the next step, that's completely up to you. But we'd love to have you join us. All right. One other thing I'll mention here about EarningsBeats and our site is that we do, you may watch my Trading Places live show here at StockCharts on Tuesdays and Thursdays, and you may not be aware, but on Mondays and Wednesdays at the exact same time, 9 a.m. Eastern, we host at EarningsBeats at Trading Places Live, which you can come in for free. You just come over, usually by about 8:45 in the morning on Monday and Wednesday Eastern. If you come over and click on this Trading Places Live link right there, there'll be a listen live button that'll come up. Now, right now, of course, it's Thursday morning and we're not getting ready to do the live show. So it just gives you a link to our YouTube from yesterday's show, which you can go over to YouTube, by the way, and check those out. But right here, just come in here to Trading Places Live Mondays and Wednesdays between about 8:45 and 9 o'clock, and then hit the listen live link and it'll bring you right into our room. It's free. Again, no credit card required, anything like that. We do, anybody who comes in, if you, when you do enter, you're required to give email address. When you give your email address, we're going to add you to our EB Digest. That's the only thing. And then again, if you don't like it, you can unsubscribe. And I think you have to actually opt in. I think once we set you up, you still have to opt in, I believe. I don't do all that, but anyway, if you are added, you can always drop it at any time. The other thing I'll just point out real quick is that over at YouTube, you can see this is the the video. This is what I was going through yesterday. But you can go over to YouTube and pull up my videos. Just go over and type in Trading Places Live, EarningsBeats.com, and it'll bring you to our basically our YouTube channel. And then it'd be great if you subscribe. So I'm already subscribed, but if you hit this subscribe button, that would be awesome. Help us out at EarningsBeats. So we'd love to have you as part of that community as well. So daily market recap. Yesterday, I thought was a really good day for a number of reasons. First of all, the Fed got more aggressive raising at 2 o'clock yesterday. The Fed announced that they were raising 75 basis points. Also announced that they were looking probably to raise 75 basis points again in July at their next meeting. So they're kind of just getting that out of the way, trying to be transparent. And then but they did say that they were going to take it meeting by meeting, essentially saying, we're not quite sure exactly what we're going to do. We're going to do whatever we need to do. They reemphasized that their target goal for inflation is 2%. And obviously they're riding way above that right now. And so that's main reason, primary reason for these rate hikes is to try to slow down inflation. This is the way you approach inflation. If you go back to Economics 101, you get an inflation problem, you raise rates. And the whole idea is just to try to balance demand and supply. I think some of that will take care of itself over time. Obviously, the Fed believes it needs to continue raising at a feverish pitch to continue to fight inflation. And we'll see, how effective they are and how the market reacts to all of this. And that's what I look for. I don't pay so much attention to the news and what the Fed's doing. I mean, I do from a fundamental perspective. Obviously, the Fed's been very hawkish and turning more hawkish. And that generally is not a great thing for the stock market, but I think it'll pass in time. So my question isn't what the Fed's going to do. My question is, how is the stock market going to react to it? Where does the money start rotating? That, to me, is the most important part of technical analysis. Because Wall Street, if you follow me, I'm not a big fan of the media. And, when I see CNBC, a lot of the times it reminds me of that, what was the song? I think it's Gloria Trainer. has a song out that says something about if your lips are moving, it's a lie, lie, lie. That might be a little bit harsh, but I don't want to pay attention to what the lips are doing. I want to pay attention to what the money is doing. To me, that just seems like common sense. Don't tell me what you think. Show me what you're doing. And so the money doesn't lie. And so I'm constantly looking at rotation. So yesterday, what we had after a lot of selling leading up to the inflation, we had big inflation reports out starting last Friday. CPI for May was out. And then on Tuesday, we had the PPI. May PPI was out. And then yesterday, we had the Fed. I mean, I'm kind of looking for a relief rally just because we got a little bit of this behind us. So I was a little surprised when I woke up and saw the futures as red as they were. Not completely surprised because I did talk to members about the possibility of a Thursday gap down. But I would have expected it more if we saw the sell-off after the the Wednesday 2 o'clock announcement. If the market had sold off big yesterday afternoon, I would have actually been expecting this. But because we were strong and the rotation was very bullish, that's what kind of caught me by surprise. But this might be another attempt to accumulate shares. I don't know. That's why I think today's action and Friday's action is going to be really important. Do we not only see a gap down, but do we see truly selling and distribution in key areas? Because if that's the case, we might not be at the bottom that I'm calling for this week. I really think with sentiment, with all the rotation I'm seeing, that I believe the low this week, and that's what I told members, I believe the low this week is the bottom. And I started buying as though the bottom was in the last couple of days. But it's like trying to call a stock at a bottom or a top right before its earnings report. I mean, it's almost like, financial suicide to some degree. And a Fed announcement is very similar, except a Fed announcement doesn't affect one stock. It affects the entire stock market. So, what the Fed's doing, whether they're hawkish, dovish, somewhere in between, their language, whatever they're saying, all these things have big impact on a myriad of stocks. I mean, just a huge, the entire stock market to some degree. So it's a bold call to try and call bottom a day or two before that. So that was the caveat. I was calling the bottom, but with the Fed meeting, maybe we get one more low. And I think that's the possibility we're seeing this morning with futures. So where do we go from here? I don't know. We're going to find out together. Anyway, yesterday, Dow Jones Industrial Average gained 1%, S&P 1.46%, NASDAQ 2.5%. And that's what we've been seeing lately. A lot of relative strength, more relative strength recently in the NASDAQ. Mid caps up 1.14%, small caps up just a little less than 1%. The makeup of the rally, though, discretionary led, almost 3% higher. Then you had real estate, defensive group, up 2.3%. They had just been beaten down a lot. I think that was just more of a bounce, dead cat bounce there than anything. Communication services up 2.25%. There's technology rising 2.1%. Energy on the other end of the spectrum was really the only major laggard, down 2.21%. But we're into option expiration week, and energy is the only thing that's been going up. I always call this week opposite George week, a Seinfeld reference, because, in that episode, George talks about, the fact that his life's miserable. And Jerry's like, well, if every decision you make results in you being miserable, why don't you just start, making the opposite decisions? And so he starts making opposite decisions, and everything in his life starts, it's kind of humorous, but his life starts turning around. Anyway, that's the reference. Looking at the stock market, I look at options expiration week as opposite George week. Whatever the market's been doing, look for the opposite. And so energy's been going up, look for it to come down. Market's been going down, look for it to come up. So that's what's been happening. Of course, again, futures really weak this morning. We'll see what happens at the opening bell and then throughout the day today. Let's move on. 10-year Treasury yield. We finished yesterday just under 340. We did pull back. I think a lot of folks, after selling bonds, I think they were running for the hills heading into this Fed meeting, and that's why the yields were going up. So remember, yields and prices go 100% inverse to one another. So if you're buying bonds, it sends the yields down. If you're selling bonds, it sends the yield up. Always remember that relationship. Anyway, this 10-year treasury yield had been going up because there was a lot of folks getting out of bonds. It makes sense. The Fed has announced they're going to be selling bonds. So I think what we're seeing is some front running. If you know the Fed's going to be unloading, you know, it's kind of like looking at a stock and saying, you know, somebody's announced they're going to, you know, unload 100 million shares of a stock. Well, you can go out and buy that stock if you want, but there's going to be some overhead pressure. There's going to be some overhead supply because we know somebody's selling a huge block of stock. Well, in this case, the Fed is announcing they've been holding all these securities. They've been buying them for the last several years. And now they're talking about getting rid of them and they're going to start selling them. So it makes sense that other traders would sell them as well. And so I think we're seeing a little bit of front running that sent the yields higher. Yesterday, I think was just profit taking. Anybody who's been selling bonds may have decided they wanted to jump back in for maybe a relief rally in prices, which would send the yield down. That's what we saw yesterday. However, today, let me give you the latest here. The 10-year treasury yield right now up 9 basis points this morning to 3.48. And the high that we saw on Tuesday was 3.48. So we're right back up to the high. By the way, crude oil prices have been coming back down, though. We are down $2 this morning to about $113 a barrel. We were just up over 120 recently. So there you have that as far as economic reports due out today. In about a half an hour, we will be getting, of course, by the time you get this, we will have already released initial jobless claims, May housing starts, and May building permits. Initial jobless claims, for the most part, over the last 6-7 weeks have been coming in higher than expected. Last week, we had 229,000. This week, we're expecting 220,000. Again, I believe we're probably going to be higher than that, just because that's been the recent history. May housing starts are expected to drop from April levels. April was 1,724,000 units. We're expecting that to drop to 1,695,000 units. Building permits also expected to drop. April, 1,819,000 units, and we're expecting that to drop to 1,780,000 units. And then later this morning also, June, Philadelphia Fed Manufacturing Index. May was 2.6. June is expected to jump slightly up to 5.5. So those will be the key economic reports to watch today and see how the market reacts to that. All right, talking technically, I just want to show you first the S&P 500. I mean, it looks like maybe we're, you know, trying to maybe carve out a bottom. You can kind of see this gap down in these 3 candles in a cluster. I thought with the rebound yesterday, I honestly was expecting that we could see maybe the S&P 500 gap up to 3,900 this morning and leave these candles on an island. That's what I was expecting. Well, we're still on the island because it looks like the S&P, based on futures right now, looks like we are going to be opening down near this low right around 3,700. So after it looked like we were breaking out of this range yesterday afternoon and then potentially gapping up to leave these, you know, this would be a reversing an island cluster reversal if we had gapped up, but we're going the other way. So if we stay at 3,700, gap down to that level and then maybe rally from there, that would keep us in this island cluster. If we gap down to 3,700 and keep going lower, that would obviously break us to the downside out of this cluster. And then you've got fear and panic that could drive prices lower significantly today. Now, for my bottoming call, I mean, you see this candle right here where we put in a low below the prior low, and then you reverse back up on increasing volume at the end of the day and print a hammer. And then you see that kind of recovery. That's the kind of candle that I would really like to see print. I mean, it would be scary intraday, but a reversal, I think, could hammer out a bottom. Now you might think, okay, that's a short-term bottom. And okay, maybe, I guess we could have an argument on that, whether that's short-term or long-term. I think these prior bottoms, we didn't have everything else coming together. And I'm going to show you what I mean in just a minute. But at these other bottoms, everything was still pointing to me to be lower prices. So when we bounced, it was just short-term capitulation and a bounce. Short-term capitulation and a bounce. Short-term, well, right here, short-term capitulation and bounce. Short-term bounce, short-term bounce. This one appears to me to potentially have more substance to it from a longer-term perspective. And that's what I want to talk about in rotation and sentiment. So here's that same chart, the S&P 500. And, you know, same one-year chart. The only thing is, the difference is I've added all these different ratios. So at the top, and I talked about this yesterday over at EarningsBeats, Trading Places Live, because I don't know how many of you follow both of the shows on both sites. But here, the S&P 500 was going higher. And look at my QQQ spider ratio going down. When the market's going up, these are aggressive versus defensive or growth versus value types of ratios. So when the market's going up, we want these ratios to go up. And when the market goes up and they turn lower, that's a warning sign. And so when we hit that high back in January, the ratio was lower here. XLY, XLP, another key ratio, probably one of the most important to me, had turned lower. That was a warning sign. IWF, IWD, growth versus value, at the large cap level, turn lower. Another large cap growth, large cap value ratio right here, turn lower. Mid cap growth versus mid cap value had already turned lower, but just continued in December. Same thing with small cap growth versus small cap value. So they all started turning down when the market went up. But there were other signals as well, like incredible, the sentiment had gone so far to one side. I mean, now we're very, very pessimistic. But at that point, we were incredibly optimistic, thinking that the market couldn't go down. So complacent, that's the word I was looking for. So we had extreme complacency in the market. We also had negative divergences on the weekly PPOs. So all of this stuff was coming together. That's why I talked about a top back at the end of last year, when it wasn't normal for people to talk about tops, other than people that always talk about tops, the perma bears. Anybody who was bullish or mostly bullish was still bullish. I flipped and went the other way. I just thought the risks were too great to continue staying on the long side. So on the way down, what I want you to focus on is prices keep going down. Look at the ratios going down all the way down this. Every one of these keep going down. The only time we bounced was when the market bounced, and you can see then we bounced there. But at the lows, we kept putting in new lows. I want you to look at this last one. Now, again, take you back up here. Higher highs, lower ratios. Lower lows, higher ratio. Higher ratio. Higher ratio. Higher ratio. Higher ratio. Higher ratio. Listen, I'm not making this up. I'm not trying to pigeonhole my bullish outlook on everybody. I'm just following the charts. Maybe they're going to be wrong. I don't know. I use this to manage risk. At the top, I got rid of risk. I basically this year have said, I'm sitting in cash overnight. I don't trust this market. Once we started to get into these highly volatile moves, you just don't know where you're going to open the next morning. And so I didn't like that risk. So I opened almost every day of 2022 with either 100% cash or very close to it. And I might trade intraday, try and get the moves, a little, 1% or 2% here and there. That's been my strategy. I don't like that strategy. I would much rather have my account full of longs, swing trading and holding for weeks at a time. This is not the market you do that in. And the signals back in December is what told me that I didn't want to continue treating the market as I had in 2020 and 2021. Now I've been in cash for 5.5 months, and these signs are starting to tell me I don't want to just sit in cash, that I want to start becoming more aggressive, which I did the last 2 days. So I'm not going to be very happy at the opening bell today, I can tell you. But I want to see what happens at the opening bell, because the other chart I want to show you right here is this is the 5-day moving average of the equity only put call ratio. Look at where we were at the end or beginning of 2021, and even throughout 2021. We had these readings that were just crazy low. And as a result, the market was just so complacent. Anybody who wanted to buy had bought. And so we were running out of buyers. We needed to reset the sentiment. Look at the sentiment. It goes down, up, down, up, down, up, down, up, down. We got to a high right before the pandemic. And then big move to the downside here, where we got very, very bullish. So this very bearish, this was actually the pandemic. And then from there, we got very bullish again. Now we're resetting. Every major bottom in the S&P 500 this century has come with this 5-day moving average getting at least a 0.75. We just set a new high at 0.79 yesterday. And looking at futures, I think we could be easily over 0.80 today. This is important stuff, because now we're getting to the point where everybody's turning bearish. Everything's tilting the other way. And so when everybody thinks the market can't go up and they start getting bearish, you start running out of sellers. Now, secular bull market can go on for a long time. Secular bull market and cyclical bear market, secular bear and cyclical bear are basically the same thing, except secular goes longer and it goes deeper. They're both bad. It's just that cyclical doesn't last as long. And that's what I believe we're in. And I think getting us to this level is another indicator that we're almost there. Anyway, earnings, Adobe comes out later today. I just wanted to point out, Adobe's been downtrending. Their AD line's been going down. On a relative basis, let's see after earnings if they can hold their relative low from back earlier in the year, back in March and April. That will be critical for me on that one. All right, the 3 you must see. I'll tell you, I'm just going to pull up a couple of big names here. Let's look at Disney, which has continued to move lower. AD line continues to move lower. Relative strength continues to move lower. Still not seeing anything yet to get overly excited about Disney. Zoom, one of my favorite stocks right now. AD line is turned up. We've been bouncing off the 20-day, which is now above the 50. That hasn't happened in the last almost year. So very, very good in developments on Zoom. Zoom now on a relative basis versus its peers is at about a 3 or 4 month high. This is one stock that I've talked about. I think's bottomed already. So watch Zoom. And then one other stock. Let's see. How about we take a look at DocuSign, which just came out with earnings recently. Took the big gap down. Still trading lower. AD line's gone down. Relative strength's down. This one I think we still have to watch. All right, that's it for me. I appreciate you tuning in. Really hope you come over to EarningsBeats, sign up for our free newsletter, and then also check out Trading Places Live on Mondays and Wednesdays. If you haven't been coming over, all you got to do is go over and click on this Trading Places Live 15 minutes before the show starts, which is at 9 a.m. Monday and Wednesday. Come over and check that out. Everybody have a great day and watch this action closely today. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.